Welcome to Insurance Insider. I'm Jeremy Hallett, and today we're going to have a conversation about the Washington Cares Fund. Let's go through some rules and have some thoughts on it. So let's begin with a short summary of what the Washington Cares Fund actually is. This is the first publicly funded program that's been created to provide long-term care benefits to Washingtonians with a basic level of protection. So this program will become effective next year, January 1 on 2022, and payroll deductions begin then as well. So this is a state level program in Washington where workers will pay a premium tax through payroll deduction, and the bill's name is the Long-Term Services and Supports Trust Program, and the public name is the Washington Cares Fund. On January 1 of 2022, every W-2 employee will pay a premium tax through payroll deduction at an initial premium tax rate of 0.58% of the employee's wages. So that's just right, almost a little over half a cent per $100. These wages will be taxed without any limitation or any capped amount. Self-employed individuals actually have the option to elect coverage, pay the tax, and be part of the program. Otherwise, self-employed individuals are not included in this program. Employees may apply for an exemption from the payroll tax as long as they have private long-term care insurance on the books prior to November 1 of 2021. That's this year, November 1 of this year. Benefits for state-approved long-term care services are available beginning on January 1 of 2025 because of how you vest in. We'll talk about that later, with a maximum lifetime benefit of $36,500 per person. That's adjusted annually for, again, fully vested individuals. To be a qualified individual who is an eligible beneficiary of this program, you must be 18 years or older, meet the requirements and assistance for ADLs. Later on, we're going to talk, there's 10 ADLs, not 6. And then you cannot have already exhausted your lifetime benefits. Lastly, these benefits are not available to individuals who have permanently retired but were unable to vest, are already retired, or they're working and paying tax for the program, but they have not met either of the 2 vesting requirements yet. Or, pay attention here, they're not residing in Washington State when they become eligible to receive the benefits, even if they've already vested in. All right. And it's important to take note here of what Washington is doing, because there are at least 4 other states right now that have publicly stated they're contemplating doing something similar to what Washington has done to protect their state from the liabilities of long-term care needs. Those are California, Illinois, Michigan, and Minnesota. So before we launch into the details, this is a quick disclaimer. What follows is a summation, right? This is not, it's only intended as information as I get it. I've had conversations with experts on this subject, but by no means is this a complete description. And it is very possible that Washington will continue to evolve the program. So for deeper information, well, go online, get all the different House bills or the substitute House bills or the substitute Senate bills on how this works. I've gone through those. I'm sharing some of the things that are happening here, but that's my disclaimer. Awesome. That part's over. So let's take a look into what's actually happening in Washington around this program. So the first question you might ask is, who's included in this program? Well, W-2 employees, right? Obviously, 18 years or older are automatically included, and they're going to pay a payroll tax. So this is important because employees who own long-term care insurance right now have a very short window to opt out of this program and not have to pay the tax. So self-employed people are not included in this program, although they can choose to if they want to opt into the program if they wish. There's a time horizon to make that decision. There are some people who are ineligible for the program. Okay, so benefits are not available for individuals under the age of 18, along with people who are already permanently retired, people who are not vested in the program, and most importantly, individuals who are not living in Washington State when the LTC event occurs. I can't say that enough. You've got to be living in Washington when the event occurs. Even if you've already been vested, you can pay in your whole life and have it occur somewhere else. So anyway, so the cost of this program is going to be funded from the W-2 employees' wages with remuneration beginning on January 1 of next year, right? They're going to start taking that tax next year. So I've heard already from multiple people that this is beginning as an underfunded program. So expect changes over time. Okay, the premium cost, let's call it what it is. It's a tax. Again, it's going to be deducted at 0.58% of the wages of this W-2 and wages. Since there's no cap on those wages that will be taxed, unlike Social Security, that means an employee making $100,000 a year will be taxed at $580 annually. $250 means you pay $1,450 per year. And if you're one of the fortunate few to make $1 million a year, you're going to be paying $5,800 per year in taxes into this program that will be worth at a maximum $36,500 of benefits to you. Now, self-employed individuals have the option to elect into coverage, but you're not required to do so. So self-employed Washingtonians are simply not included into the program unless they make the choice to elect coverage. So self-employed people, like those are independent contractors, sole proprietors, partners. You don't have to say anything yet. You have actually until January 1 of 2025 to choose to elect into the program. You got a little bit of time if you want to take a step back if you're self-employed and wait to see what happens. Also, it's within 3 years of becoming self-employed. So later on, you may be able to, if you become self-employed for the first time, but really 2025 is your number. It's when you should make your decision by. For an individual to collect benefits, you must be vested into the program, and there are some requirements. So these requirements mean that you must be employed and pay that tax for either 10 years without any interruption of 5 years, consecutive years or more, or pay a premium tax for 3 of the last 6 years. And, you know, if you retire before you've paid enough in to be fully vested, there is a partial vesting benefit for you. But that individual must work for at least 500 hours in each of the last 10 years or those 3 years required. Here's the way to think of it. Over about a 10-year period, you need to work at least 10 hours a week, which ends up being about a full-time seasonal job, if you think about it that way, okay? So to become an eligible beneficiary of the program, an individual must be at least 18. You must be vested. You must meet the requirements, right, of assistance for those ADLs. There's 10 of them. We're going to get into that in a second. And you cannot have already exhausted your lifetime benefits. Then you're an eligible beneficiary. How does one actually qualify for these benefits? An individual needs assistance with three out of 10 ADLs, activities of daily living. So pay attention here. So there's a few new ones for anyone who has knowledge of long-term care products. Okay, in no specific order: bathing, transferring, eating, toileting, dressing, mobility, body care, personal hygiene, medication management, and cognitive impairment. Those are the 10. You got to have problems with 3 of those. Of course, the individual must be living in the state of Washington as a resident at the time of claim. Finally, we get to have a conversation now about how big are these benefits. I know I just gave it away twice already, but here's what they are. They come in units of $100 with a maximum lifetime benefit of $36,500 adjusted annually. And this makes that $100 a day policy for 1 year, if you think of it that way, right? $100 times 365 days, $36,500. So a nice feature of this program is that an individual has the option to take less per day to stretch out their benefit. Also, those $100 units can be combined if daily expenses are higher. And this is a reimbursement plan, though. So, you know, those benefits are paid directly to reimburse the care providers. And those care providers, again, must be, you know, state approved. So these benefits can be used for things like home delivered meals and in-home personal care. They can pay for home modifications, including adaptive equipment and technology. They can also be used for training, certifying, and compensating qualified family caregivers. Interesting. And of course, the units can go towards assisted living, adult daycare, and nursing home services. There is a rumbling in the insurance world right now about individuals who are rushing to opt out of the program. I won't conjecture around, you know, whether or not this is a positive or a negative for insurance companies, although I've actually spoken to carriers on both sides who some want it and some don't. It's very interesting. So let's take a look, though, at how individuals can opt out if they want to. For starters, employees who can attest to having a long-term care insurance policy can apply for an exemption from this premium tax. So that life insurance policy that they attest to having must have a policy date before November 1 of 2021. That's this year. Okay, we got just under 5 months before this has to be in place. And once that employee gains an exemption, they're permanently ineligible for coverage under this program. Okay, the period, though, now for the person to request an application for the exemption runs, it's throughout the whole fourth quarter, October 1 to December 31 of next year. So you actually have, call it 5 quarters to ask for an exemption. And then that exemption actually begins from the tax begins the quarter following the date the exemption certificate is provided to the employer. You get a certificate from the state, you got to give it to your employer. It's the following quarter you get your exemption. And finally, that employee is solely responsible to provide written notification of their exemption to all current employers and all future employers. So think about it. It's your responsibility, if you don't want to pay the tax, to continue to tell your employers that you don't need to pay the tax. An employee who wishes to qualify for an exemption needs to understand what qualifies as long-term care insurance so that I can actually ask for an exemption and receive it. So the easiest way for anyone to understand if their current policy or one they're in the process of purchasing to qualify, does the policy follow 7702B? That's it. Or if you're not in our insurance world, look for that. So there's multiple insurance and annuity contracts out there that mimic long-term care that actually follow a tax code called 101G. We need 7702 to make this a go. All right. So a qualifying private long-term care insurance product, okay, this is what we're looking for, is a product approved for sale in the state of Washington. It's going to comply with that definition of long-term care insurance as set forth in the piece of legislation that's finalized. And suffice to say, just feel free to look this up and go read all this language. It's a pretty comprehensive bill. Just remember this. Is it long-term care that follows 7702B, and is it approved for sale in the state of Washington? So there you have it, my friends. This is a huge opportunity wrapped up in a piece of legislation from the state of Washington. But remember what I just shared at the beginning. Washington may be just the first domino. States are going to need to find revenue to support residents who need long-term care services. And Washington just found an interesting way to tax W-2 employees to pay for some of that liability that's falling on the state. This is beginning as an underfunded program. It's an experiment. It's going to be very interesting. And as I said in the beginning, there are 4 states that have at least publicly stated that they're contemplating doing something similar to this. Those are California, Illinois, Michigan, and my own state of Minnesota. So some things for Washingtonians to consider, and maybe for anyone. Clients who are planning on retiring out of state are not going to be eligible for this program. So you really might want to consider purchasing a plan quickly, like before November 1, so that you won't have to pay if you can be an exemption to the rule. Clients who are nearing retirement may well want to work a few more years if you want this benefit. So you may need to work a few extra years to vest. And possibly a long-term care insurance policy might actually pair fairly well with these program benefits. I think we know a lifetime benefit of $36,500 is not nearly enough to cover long-term care needs for people who need them, according to pretty much every study I have ever read. This is really a great time to have a conversation with your clients, your advisor, or your friends about long-term care, because few of us really enjoy talking about our own morbidity or our loved one's morbidity. There are a lot of people in Washington right now who are going to apply for a policy. It'll be the correct policy, but it's not going to be issued in time. And they're going to be unable to get a policy date of before November 1 of 2021. There's a lot of applications going to the carriers right now, and they're not going to be able to be exempt. So if you're contemplating doing this, or your clients are contemplating doing it, get on it right now. Finally, this is the real opportunity here, is just to get your long-term care insurance in place, especially if you're in one of those 4 states I was talking about. If they're going to follow the cookie cutter recipe of what Washington is doing or something similar, get your insurance in place now, even if it's just a small policy, if you want to be exempt from a tax like this. Well, there you have it. I really appreciate you listening to me today. Hope you're doing well, and look forward to talking to you the next time. See you later, guys.